how to, master markets. I'm going to go over 7 different option strategies that I think you're going to really be interested in, and they're very dynamic to see how you can control your risk and also be buying options at a discount. So we're going to go through 7 different types of plays, but they're going to focus on 2 that are really 2 of my favorites: the calendar and calendar diagonals. But that being said, let us get started. So first off, again, thank you so much for being here. I love these Saturday events because the markets are closed. We can kind of kick back and don't have the disruptions and the noise of the market around us, and can kind of go through the markets. And we're going to go through these different strategies, and it's interactive. So please make sure to ask questions as we go. If there's anything you'd like to for me to check out, or go ahead and ask. If I missed your questions, the GoToWebinar will scroll down, so sometimes they kind of scroll off. So just put them back in. Be happy to go there with you. So a little background on myself. I've been, started my trading journey back in the 80s on the oil side, and I was fortunate to get into a company called Coastal Corporation that at the time they had a training program that were, for people coming out, looking for a job, and they would actually train you to trade oil and oil products. So it was a really fantastic opportunity for me. I was able to get my foot in the door and got in with Coastal. They sent me down to their refinery. They had a number of different refineries, one big one down in Corpus, Texas, and they sent me down there for about 3 months, and it was really great because kind of got you, the foundation of oil. You kind of learned how, the oil tankers would come in and, offload the crude into the refinery, go through the distillation units and produce the products, and kind of see how the whole thing, came together and worked. So it was a really great experience. Spent about 3 months there. Ended up in the, tanker chartering division, and chartering tankers and scheduling the oil and things like that. So just a great all-around experience. And finally ended up on the trading desk, and sent me out to Singapore for a couple of years, about 2 years out there, and traded products and crude oil, the Asian crudes, and a lot of different, all the oil products, a lot of fuel oil, MoGas, things like that. So really great experience. Then eventually I ended up with a company called Transworld Oil, which at the time was the largest oil trading company in the world. So it was Transworld, Fibro, and Mark Rich. They were the 3 biggest, and spent about 17 years there. And 16 of those years were in Bermuda, which was the corporate headquarters, and ended up running the international trading desk out of Bermuda for 10 years. So we traded everything. We were in all the different markets, heavy in the energy side of things, but eventually branched out, got into foreign exchange, all the different futures markets, and that's where I started trading options, basically on crude oil back in, I remember 1987. I remember my first option trade. It was selling a option premium on a cargo of Brent crude oil. So it was a fantastic start, and never looked back, and options have been my favorite way to go. So we are going to talk today about some premium collection strategies, which we can all do. You don't have to be an oil company, so I'm going to go through 7 different premiums kind of option strategies that hopefully everybody here can get a lot out of. So make sure you get your notepad out, take notes, and ask questions. So let us get started. So the following presentation workshop today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. Now, option income selling strategies uniquely enable you to enhance returns by the way of combining long options with short options so that you can generate income on a regular basis. Now, these types of strategies are typically short in duration, whereby option premium is sold either on a weekly or a monthly basis. So you can then generate, significant percentage returns on the underlying security, even if it hasn't moved. So it's really like, collecting rent on a security that you own. So, if you own real estate, you're, collecting rent on that. So why not do it on your securities and stocks and ETFs that you own, and, any portfolio that you might have, or just for trading. So it's a great way to collect income and make that new additional revenue stream. Now, step 1, though, is the secret to these strategies. It's really knowing how to sell time. Now, when trading options and option strategies designed for income, the most important option factor is really to understand the concept of time and the impact that it has on the price of your option. So we can actually sell time or trade time by selling time to take advantage of that option time decay, or what's known as the time value. And so the thing that makes the options pricing work is the two major pricing components. The first one is your time value, or what is known as your extrinsic value of your option. So it's the premium that a trader or investor is going to be willing to pay over the current exercise value, that intrinsic value, based on the option's potential to increase in value before it expires. Now, the change in this value of your option based on time decay can be measured using the Greek called the theta. Now, time decay then also increases as expiration draws near, so it really starts to accelerate, but it actually decreases as the options go more in the money or out of the money. Okay, so you're gonna have actually less extrinsic value. So that's gonna, a lot of times help that situation when you're looking for that less time decay. Now, this option theta accelerates and really starts to accelerate fast when you get to that 30 days out towards the end of your option cycles. So that's where it really starts to soar. And here's a really good time kind of graph. You can kind of see this. So if you go out, say 120 to 90 days out, the time value decay or time decay is going to be very, very slight. But as you get closer in, you can see it starts to tail off. And once you get about 30 days out, then it starts to really accelerate and goes to zero at the end of the expiration series. So that's what we can really take advantage of with weekly options and also daily options to collect this premium and also buy cheaper options based on that time decay. So it's a really important part of all your option trading to understand that, and then understand how to take advantage of it, and then put it to your favor for your trades. So the next step is then knowing how option pricing works. So when we look at the option pricing, it comes down to really kind of three components. You've got your time value component, which is your time decay. And then you have the implied volatility, and then you have your underlying security. So that's the intrinsic value. Now, once you know these variables, then you're being ready to price out your option and know what the premium should be, and then select the right appropriate strategy to use. So looking at this table, it kind of illustrates also how this time decay can work and how the value or the premium of your options is determined. So let's say, for example, every Thursday we have a new weekly option series. So on that first day when it comes out on a Thursday, you have a 100% time in that option. All right. So, then we have the time value times its underlying implied volatility of that option times the underlying security value, which is your intrinsic. So we're going to leave this at a constant of 1, so you can just see how time and volatility impact the price of your option. So that first day, you've got 100% time, okay, times your implied volatility. I just put in plugged in a number here of 300. So you can see your value of your option here then would be $300. Now, if you come back in after the weekend on a Monday, you're going to see that time value component then has been cut in half. And so even if the implied volatility has been spiked up, I put it up to 800 right here, you can see it barely pushes the price or the value of the option up. So it would be $400. Now, let's say the implied volatility was only 200, and then you've got only 1/2 that time value component left. You can see then your option price is only going to be $100 in value. So you can see how these two variables can really affect the time component of your stock that you're trading. Hold on one second. Sorry about that. Somebody called spam. I don't know who that is. Anyway, so that's how you look at the value of your option. So time times the implied volatility times the underlying security value is basically the components that are going to give you that value of your option. So once you understand how option pricing works, then you're going to be ready to go and look at what makes the different option strategies work. Now, step 3, though, is also to understand probabilities, and what's, what I call the market maker's secret. It's what they don't want you to know, and it's how they take advantage of you when they're making a market. So this is, the professional money, the market makers, and what they do, and what they're doing is, selling that premium. So the option markets, what they're, using are mathematical market probability statistics for pricing out the movement of your option to its expiration. So the option pricing model is called the Black-Scholes model. That's your, the basic model. And all the different platforms we use this basic model, they might tweak a little bit, with the different little formulas that they put in, but it's all based on the Black-Scholes, which inputs implied volatility, days to expiration, the value of your security into it, and the model then puts out the different values of an option based on where we are in time. So these are your mathematical probability statistics that we can use, for our trading. So by knowing the probability of your underlying stock finishing within a certain price range at expiration becomes key then to determining then what options you're going to buy or sell and what option strategies to use. Now, this forecast is what we refer to or call the implied expected move or the implied move of your stock. And what it is, it's the estimated plus or minus 1 standard deviation move of the underlying security by its expiration. All right, so this is where you want to start with every option trade. Is you want to know, okay, what is the implied move? What is the normal move up or down, which would be this 1 standard deviation move based on the days you have to expiration of that option series. So this is a major step that you want to understand. Now, when we are selling options, this is what really makes the difference as far as understanding what you're getting and what happens when you do sell an option. So if we're selling out of the money option that's 1 standard deviation out, you're basically starting out with an 84% theoretical probability or chance of that being a winning trade. Okay, so the way this works based on the math is, let's go through this example here. So this is a normal distribution curve of data. So this is going to be price data. So we have at the top of this bill curve, the price is trading at the money at $500. So let's say the implied move is giving us, based on the implied volatility, time to expiration, etc., is giving us implied move of 4% up or down. And let's say we have 10 days until this expires, this stock ABC, and it's trading at 500. So based on the 10 days expiration, an implied move of 4% up or down, that would give us the implied move would take us to $520 would be the outside point, and also then 4% down would be 480. So that is basically what we're calling 1 standard deviation. Okay, that would be the price range between the two, 480 to 520. That is, 1 standard deviation down and up, or down and 1 standard deviation down. And what that equates to is when you look at your option deltas on your option platform, this price point of 1 standard deviation up would be like a positive delta of about plus 16. So basically, when I see a plus 16 or 20, that is telling me that's about 1 standard deviation, to the upside. Or if I see a minus 16 or 20, that's a 1 standard deviation to the downside. Now, when you look at option delta, what a delta of 1 equates to is like the equivalent to 100 shares. So if you had a delta of 1, which is equivalent to like 100 shares, and you had an option delta that you sold here, like this 520 strike, let's say it had that plus 16 delta. If you take that 16 delta, then the difference reciprocal there is 84. So the way that you can look at this, and again, this is theoretical, but this is where we start with our option trades, is that if you did sell this 520 point here short, then theoretically you're going to have, going into this trade, an 84% probability that the price will be below 520 at expiration over that, let's say, 10-day period. Now, the other side of the card would be, let's say that you sold the 480 put, then that's going to also then be the same, that you would have an 84% probability theoretically that price will be above 480. Or the other way you can look at it is there's a 16% chance that price will get to 520. All right, so this is really important when you start any option trade. The first thing we always look at will be what is the one standard deviation move. So that would be kind of a normal move that it could go up or down over that period of time. Now, if you're expecting to go much further than that, you can see that it really starts this tail, really the probabilities get lower and lower that it can get there. So here would be like 2 standard deviations, right? So that might be like 540. So there's there's only a 2 to 3% probability that price will get there, or basically it's like a 3 or 5 delta. So you've got a 95% probability that price would be below that price. Okay, so that's how you can use your option delta to quickly assess the probability. So that's a really important thing to understand is your deltas and how that equates to the probabilities of your chance to having a winning trade. And that's where we start when you're looking at selling options, that theoretical probabilities of your trade working out. So here's a good illustration of an option chain with the option delta giving you the kind of the trade probabilities. Now this is Thinkorswim trading platform, and in this example it's Apple. So Apple was trading here at about $190, and in this series, this 5 July series, there's 28 days to expiration. Now if you look here at the delta, you can see delta here, and right over here to the left of it says probability. That's actually probability out of the money. So with the Thinkorswim platform, you can then look and kind of assess the probabilities of a price being, out of the money, and what that probability would be. So we are trading, let's say right here at 190, that's right at the money. You can see the delta here is at 52.52. So basically it's a flip of the coin. It's 50% probability that price will be above 190 or 50% that it will be below 190. So that's your probabilities going into that trade. Now, as you get further out, you can see here this 215 strike has a delta of 5.05. And then you can see the probability here, probably that's going to says actually probability out of money says that it would be 95.6. So here you go. You get that delta of 1 or 100. You've got your delta here of 5. Let's say you sold that 215 strike. So you've got that 5 delta. So that's your 95% probability of price being below 215 at expiration over that 28-day cycle. Or the other way you can look at it is there's only about a 5% probability or chance that price would be at 215 or above. So that's a quick way for you to measure probabilities of a trade being at some point at expiration. So you can determine the probabilities of, do you want to buy that 215 strike, or would you rather sell the 215? So things like that you can then assess quickly using that probability delta. So by using this analysis, it really helps to give you a very useful trading tool to determine price targets to trade against. It's free on most platforms, so take advantage of it. Now, so based on this kind of math of probabilities, you can see that approximately 68 to 70% of options bought are going to expire worthless. Based on this, then it's a really good idea for all traders and investors to consider selling options just as much as you are buying them. All right, so by adding an option income selling strategy to your trading portfolio can make a really dramatic and positive difference in your trading performance over time if you're using it correctly and know how to use the various strategies that are out there available. So remember, trading is a business of probabilities, and to be successful, controlling your risk and then incorporating high winning kind of probability option strategies is really what's going to help you win the race in the long run. So it's one that you've got to, I always tell my members and clients, we're looking at our trades to hit singles and doubles, and occasionally you get that big, home run, but you've got to be consistent in your trades. So controlling risk is the first thing we look at. So the next thing is, to understand and select the right option strategy or income strategy, out there for your trading goals. So, in my opinion, one goal or the major goal for every trader or investor should be to select trades based on what's going to give you the most consistent positive returns with low defined risk and not always the greatest, home run returns. So the first thing I always look at and always preach to my members is let's take a look at the risk first, and then once we know the risk, then we'll back into the reward to that risk. So by the next step then is to understand then what are the different option strategies that you could use if you're looking for some kind of income, or if you're looking for profit generation with really controlled risk. So what we're going to go through next are some of the best, income strategies that are out there, so you can kind of get an idea of how they work, and then, maybe select the best one that's suited for your trading style or your trading goals and the market environment you're trading. So, let's take a look at all the different ones. Now, we're going to cover go over seven different strategies that are pretty much geared for premium collection and also for, really potentially good profit generation type trades. And also they can also give you some hedges and hedging techniques for your trading or your investing. So we're going to go over and we're going to start with the first one is the covered call, which maybe you've done or you've heard about. And then we're going to look at, the covered call with what we call the protective put or the collar. So this is a really great way to hedge a position that you're in. Then we're going to go through the vertical credit spread. So these are very popular for, premium collection. We're going to look at the iron condor credit spread. We're going to look at the butterfly. And then we're going to look at the two favorites that I really like a lot. We're going to go through the income and the income calendar diagonal. All right, so we're going to go through these and then you kind of get an idea of how they work. And then maybe there's one that, you're very interested in and you can go from there. So the first one we'll get into is called the covered call. Now, the covered call is kind of a longer term actually growth and income strategy used by investors, and also the institutions are really starting to use these a lot for their clients. So it's kind of the most basic income strategy, yet it's highly effective for bringing in either weekly or monthly income. Now, one thing to point out though, you may, I don't know, for some reason people think the covered call is a low risk strategy, but it's actually a very high risk strategy. And once we go through the examples, you'll understand. But the thing is to understand that when you do a covered call, you're owning the security that you're selling the call against, okay? So you're collecting rent on that security. So if you own that security, and the market goes down, that has a big potential downside risk to it, okay? So just, keep that in mind. Now here's an example that we'll start out with. So Joe owns 500 shares of the company XYZ, and he bought those shares for $40. Now, he's tired of just getting that 2.5% annual dividend, that he collects on the shares of the XYZ. So he wants to earn more income on the stock. So he's heard about this strategy, selling call options against it. So here's what Joe does. He learns how to do it, and this is what he's going to do. So on the 15th of August, Joe goes out and he sells 5 of the 26 September weekly call options against the shares that he owns, and he sells the strike that he sells is the 42.50. Now remember, he owns the shares at 40, but he's gonna sell 5 calls against those 500 shares he owns at 42.50 strike, and he's going to get $1 per option contract that he sells. Now remember, one option contract's equivalent to 100 shares, so he sells 5. Now he gets that 500 in his brokerage account right off the bat. That goes straight to his account, and that's held there until the expiration. And so this would be, if he keeps it, this would be like about a 2.5% return in a little over 6 weeks. So he's pretty excited about that, getting that 2.5% return, but also he owns the shares, so he'll still get to keep the dividend return as well. So this is a great thing. He's getting that additional income along with the dividend that he already gets with those shares. So what it means is that Joe then has given the right to the buyer of those call options, the right to buy that stock on Friday, the 26th of September or before. So that's what we call an American option. If you're a buyer of an American option, you can exercise it and take that shares anytime up until the expiration date, right? So that's a important thing to understand. Now, the European options is only exercised on the date of the expiration, or sometimes they're just cash settled. So The American options you can exercise at any time. So that's how that works. So that would be the, the downside to Joe if it goes over 42.50. Now here's what happens on the expiration day of Friday. And option expiration is the third Friday of every month for the monthly, okay? Now the stock that Joe owns went to 42. The option then would expire worthless that he sold at 42.50 because it wasn't at that strike price. So Joe gets to keep that full amount of premium, which was $500, a dollar per option contract. So he just made 500 bucks from selling those calls, and he collected some really good rent. And that was over, like a monthly period. And so all he has to do now is just, do it again if he wants. So, what would though happen if the stock went to 43? Now, if it goes above his strike price at 42.5, this is kind of what would happen in general on an example basis here. On the day of expiration, let's say the price would have been based on the time value, maybe down to 50 cents. So Joe, sold it for $1. Now the time decay had knocked it down. It was only worth 50 cents. So he could easily then just buy it back for 50 bucks or 50 cents, and he just made that $50 on those option contracts. All right, so $1 less 50 cents, he made that 50 bucks. So he's still happy. He made about a 1.25% kind of annualized return over that period of time, in addition to those dividends. So he's still, it's still a good place to go, and he's still collecting rent, and he's just going to do it again if he wants. So that's the basis of it. So as long as Joe owns those shares, he can then, rinse and repeat, and then sell these options for the next week or the next month, and repeat this process over and over and over. And eventually what you're doing is you're amortizing down the cost of your underlying securities that you own. All right, so it's a really great way, like if you own a real estate property and you collect rent every month and you have a mortgage on it, that's going to help you amortize down the cost, and we'll, answer your questions there as well. All right, so let's get back to the next step, which would be the covered call plus the protective collar. Now, building on that covered call example, here's how it works when a stock with a covered call drops in value, and then you own a put to protect your gains against that downside move on the stock. That is what's known as a protective collar option strategy. And so what this protective collar does is just a fantastic way to protect your downside. It adds a protective put, but you also then have that covered call part of the trade already, all right? So it's going to be a protective put. Sometimes you might hear it called a married put. What that is, it involves being long a put option, and then you're long the stock, okay? So that's a protective put. Now, the other part of the trade was, Joe he was doing the covered call. And the covered call then involves also being long that stock and short the call. So now you've got a collar on that trade, okay? So you've collared the trade for downside protection, and basically you're paying for that protection by the call that you sell. So that's going to help finance that put that you buy against it. So when you combine these two strategies together, that's what we call the protective collar. Now think about this, and this will tell you how it works. So if a stock goes down in value, think about it, the call that you sold short against that call would actually go down. So if you brought in, $100 premium for selling that short call against your options, against your stock that you own, and the market goes down, that will go down, that will decay or go down in value, right? So then maybe it goes to $10, so you could buy it back for 10 bucks, and you just made $90, okay? So that protects, offsets part of the downside of the stock. So you sold the calls, that's going to protect part of the downside move there. But the other part is that you bought a put. So the value of the put option that you bought, when the security goes down, puts go up in value. All right, so think about it. So how do you go long, security using options? You go long by buying calls or selling puts. How do you go short a security using options? You sell a call or you buy a put, all right? So in this example, if we're owning a call of shares here, let's say we own shares, we sell a call against it to the upside, we buy put below it to the downside, and the market goes down, we've got that collar. So we're going to get value. This gives us value here. We're going to make money on the call that we shorted, and then we're going to make money on the put that we are long. Now we lose on the stock, but this is going to, offset a lot of the loss depending on where you have your put below your security. All right, so that's how it works. So the value then of your underlying stock goes down, but a lot of the downside price movement or potential loss would be offset by the collar. So it's a great hedging strategy, and it's one really a good one right now. If you've got a long portfolio, you might think about, collaring your portfolio, which is a great way to go as well. Now here's where it works for Joe. So remember Joe, he owns those 500 shares, and he bought them for $40 a share. Now on the 22nd of August, the stock had moved up to $45. So Joe, he wants to kind of temporarily hedge that position due to the increase in the market uncertainty. He's getting a little bit uncertain about the market. The volatility is kind of picking up. So what Joe does, he goes out and he buys 5 of the 26 September weekly puts on his stock, okay? And so, again, one option contract's equivalent to 100 shares. And so what he did, he bought the $39 strike on those weekly puts, okay? And that cost him 90 cents per option contract. Now, at the same time, though, he sells 5, again, of the 26 September weekly call options with a 49 strike, and he receives $1.10 or $110 per option contract. So Joe has then collared his stock. So here's the cost of that collar. So let's go through it. So he owns the 500 shares that he paid $40. Okay, so he's got that. And let's say here's his shares here, and he collared those by buying a put below it, buying these puts down here for the 39 strike. So he owns the shares at 40. He bought the puts down here, really, right under it, 39, and then he sold a call above it at the 49 strike up here. Okay, so he short those calls, long the puts below, and he's collared the shares that he owns at $40. So here's the cost. Let's go through it. So he had to put out of pocket $90 per contract. That's a debit cost. But then he brought in $1.10 or $110 from selling the 49 calls. So if you go through that net, he's actually received here a 20 cents per share credit by doing this collar. So now his break even is, $40 his share cost less that 20 cents. So now his break even is down to $39.80 per share. Now his max profit though has been capped at 49. That's the only downside is that if it moves up to 49, he's capped. He's not going to get the profit above that, but he's happy, because he's capping that risk to the downside, and he's got a pretty large upside, movement there. So here it is, 5 contracts, remember, times 100 to make it equivalent to an option, and then so he's got the 49 call above plus the 20 cents minus the $40 share cost. So potential profit here at 49, if he gets to 49 or above, he's capped, he would make $4,600. So that's a 23% return on his capital at risk of those shares that he bought at $40. All right, so that's a pretty good deal for Joe. He's happy with that. Now the loss though is also capped to the downside. So he's capping that at $39. So if the market just keeps, plunging to the downside, he's capped his risk at $39 by doing this collar. So here's what his downside would look like, 5 contracts times that 100. He's got the share price of 40 that he, bought the shares at, less the cost of the put and the plus the credit they had here. So his potential loss would be $400 on those 500 shares, or a 2% loss on his capital. So he's real happy, 23% potential upside, and he's capped his downside to 2% versus, a pretty big, ugly situation if the market can continue moving lower. All right, so it's a great strategy to understand on that. Now, the next one is really popular ones to use. These are your vertical credit spreads. And this is what, we kind of call probability trades. So we're going to go through and I'll show you kind of the three different types of credit spreads that you can look to do. So the first one would be what we call the bear call credit spread. And then we have the bull put credit spread, and then we have the long iron condor credit spread. So I'm going to go show examples of each of these so you can get an idea if you're not familiar with these, and so it could intrigue you to pursue this further if you are interested. So first one we'll start with is the bear call credit spread. Okay, so this is going to be one that you would use when you think the market's probably going to go down. So you could actually make money over time, even though the stock stays stagnant. So it doesn't have to go down. If it just stays stagnant, goes sideways, you could still make money. So in this kind of market, this might be a way to collect some premium on, securities where the market's kind of really grinding up and kind of churning sideways. So what you're going to do with this strategy is you'd be selling one, a call option, while at the same time buying another call with a higher strike, and these are done in the same option expiration series. All right, so this would be a bear call credit spread. All right, so let's take a look. I'll show you an example. Now, these are, what we have in negative risk ratio is also how these are described. So if, let's say you went short here, the 10-20 short strike here, okay? All right, so you're short there, and that had a delta of 20, all right? This is a short call with the delta of 20. So what is this going to tell you? Theoretically, starting out, you're going into this trade with an 80% probability, theoretically, of this being a winning trade that's going to close below 10-20. Okay, that 20 delta gives you theoretically going into this trade an 80% chance to win. All right, so that's what creates this negative risk ratio. So in this example, you're short the 10-20 strike, long to cap it, make sure you're capped your risk. So you're not naked that call. You bought the 10-30 right here. So you can see it's $10 spread between the 10-20 and 10-30. Now, one option contracts equivalent to 100 shares, so this would be $1,000 wide spread. All right, so you brought in a premium here of $200. That's your premium, and that's your max profit would be the premium received. But potential risk is the difference. So you're putting up, actually your risk is $800. You're risking to make 200. So that's why we call this a negative risk to reward ratio. So you're actually risking $4 or $800 to make that $2 or to make that 1. So risking 4 to make 1. So that's a negative risk ratio. And these trades typically will give you about a 25, maybe 30% return, depending on where you sell that short strike. So that's why they're called a probability of trade. You're probably saying, why in the heck would I risk $800 to only make 200? Well, it goes into being the probabilities theoretically. Again, like I said, if you go in that short strike at 20 delta, you're going into this trade with a probability of making an 80% chance of winning, having that price be below 10-20 at expiration. All right, so that's why it's called a negative risk ratio trade. So here's an example on a credit spread that we've done on Tesla. And this is one that was set up. And the other thing with credit spreads, you can leg these things. So, this is a good way to do credit spreads. When you get a really rip higher, maybe then you sell that 20 delta short strike and get into the credit spread. So in this example, Tesla was trading here right about here, right there, about 275. So when it's trading here, went out and sold. This was about I think a 20 delta short strike. Let me put to the next screen here. So did set up this credit spread. All right, so it was trading at 265, and then went out and it was a 23 delta short strike on that 282.5 strike right there. That was your short strike. So you're going to be short the 282.5, and then long above it the 285. So you've got a $2.50 wide spread. All right, and that short strike of the 282.5 was a 23 delta, which goes to a 77% probability, theoretical probability, when you set this trade up, that there'd be a winning trade and price would close below that short strike. Okay, that's your probability. Now on the 26, you can see it was trading at 244.55. Now the spread had blown to was $50 credit, all right, or a 25% return over that 8-day period, okay? So that's how that would work. You brought in a $50 and it went to zero, so you kept the $50. So that's your credit received, and that would be your premium, and that would be your return, would be your $50 on the risk that you had on that trade. Now, what you put up, the difference is your margin. So, you know, what you're putting up to cover that risk is the difference in the spread. So that's going to be your margin on that trade. All right, so that's how that would work. And then the next one we'll go through is the bull put credit spread. So this is going to be one, if you think the market's going to go up, it'd be one that you could use. And even if the market goes sideways and stays stagnant, it's still going to make money for you. And so what this is you're actually going to sell a put, and at the same time, you're going to buy another put lower below it in the same option series, protect the downside. So you're not going to be just short naked that put. And so it becomes a spread, so you're covered and capped to the downside if it does go against you. And again, this is a probability trade as well. So here's just an example. This was like on Apple, and this was selling short the 149 put. It had like a -20 delta, and then long the 144 put below that. So the spread width here is $5. So you're short the strike here, the 149. So you're short that put. Okay. Now you could do these naked, but you know, I wouldn't advise it unless you're really, you know, more advanced. And then you buy that put below it, and you're buying that put below it at 144. So there's your spread, 149 minus 144. So that's a $5 wide spread, or $500. And then for selling this, you're going to bring in that premium of $1.05, 105. So you bring in $105. That's your premium received. And the difference then is your risk on the trade, which would be $3.95. Now that $3.95 is what you're going to have to put up to the broker of margin, right? In case the trade goes against you, the broker has that $3.95 to cover any downside in case it's a losing trade. Now, if you keep that full premium that you received here of 105, then your return is about a 26% return. So these are kind of normal returns that you get on these trades. And you just, you know, you just chip away on these things. You're not going to make a fortune, but you're collecting rent. You're just making, some generating some revenue or income by doing these types of trades. So in this one, you know, your risk reward is your negative. You're risking $3.76 to make $1. Okay, so that's very typical when you're doing these kind of probability trades. You know, with these deltas of, you know, a normal one standard deviation is about a delta of 16. So typically, like I said, if I see a 20 delta, that's around that one standard deviation point. All right, so that's your typical bull put credit spread, which you could, bank on receiving there. Now here's an example of one that we did with NVIDIA, and this is, you know, the cycle reversal indicator and with my extreme range bands. And so you're going to get these two indicators with the course bonus package, and these are great indicators for these types of spreads. So you can see here in this example, NVIDIA had sold off really hard, and these are my extreme range bands, and so it was down below this second band here. So that's a really stretched out, getting very extreme to the price, to the downside. And then we had a reversal here, that purple arrow, and so that gives you an indication that the market's maybe going to have that, you know, snapback rally. All right, so when we had that indication with the reversal here, that's a great time to sell an out of the money bull put credit spread to take advantage of maybe that slingshot back up and collect premium. So this is, you know, an example here on NVIDIA of doing this type of a trade. So when it was down there at that extreme, it was trading at 99.66. So went out and sold short the 84.80 bull put credit spread. And at that point in time, the 84 short strike of that put was at a -20 delta. So we had an 80% probability trade set up, theoretical, going into the trade. And you can see then on the 16th, it was trading at 124.87 right here. And so that premium that we collected of $95 now was down to a penny. So, you know, just let it expire, buy it back for a penny, end up, you know, make $94 per spread. That's a 30% return on that capital at risk. So that, is a way that you could do a bull put credit spread, and that extreme range band indicator is a really helpful tool with the reversal indicator for doing these types of setups. Now, the third one is the combination actually of these two, is the combination of your vertical credit spread, call credit spread, with a put credit spread, okay? So when you combine the bull put credit spread and a bear call credit spread, that creates what we call the iron condor. So if you're in a situation where you think security or stock that you're owning will maybe trade in a very tight range between two support resistance areas and stagnate there, then this becomes a really ideal, great strategy for premium collection. But you're also going to be able to minimize your loss because it's a spread trade where you're going to be capped on the upside and capped on the downside. But what it does is going to, again, take advantage of that time decay, and also it takes advantage of what we call volatility crush. So as we get closer and closer to expiration, the time decay kicks in, but also at the end of the expiration, the last day or so of your expiration, volatility does what we call crush. It goes down to zero. So that's where you get the other big advantage of selling options. So when you sell an option, you're selling time and you're selling volatility, and this is what you're banking on will make profit for you. The two of these things go into zero. All right, so here's kind of basically what these would look like on a risk profile. So you'd be short a call credit spread, and then you're short a bull put credit spread. So the premium you receive is your total profit. So maybe here you brought in 50 bucks premium. Here you brought in 50 bucks premium. All right, so you brought in a total of $100. So that would be your potential profit. Now let's say the spread is $4 wide between the short call and the long call, and the same over here. So it's balanced, and let's say it's $400 wide. So you brought in $100 premium. All right, so then your risk is $300. Okay, so you can see your profit then would be, if it goes out between the two spreads, you're going to keep your full premium of $100. So you just made a return of what is that, 33% return. All right, so that's pretty typical. And the other really nice thing with this is you can leg in, leg out of this trade. So the next example I'll show you on Tesla, it kind of started out on the downside. We sold a bull put credit spread first, and then it moved up, and then we sold the bear call credit spread to create the iron condor. So this is typical of what you can do with this type of trade. So here's your iron condor trade here. So this is legging into Tesla, and this was on the 14th of December to the 21st. So Tesla was started out, was coming down here and looking like it was moving up. We had a cycle reversal. And so what we did was, it had this big move down and it looked like it was bottoming. So the first thing we did was sold the bull put credit spread first, and then it ripped up. See it ripping up here, and then when it was up into here, then sold the bear call credit spread further out of the money to get a better, entry set up on that. So the first part of the leg was selling the bull put credit spread when it was down. Okay, so it was going at 243.30. So sold the bull put credit spread 237.5, 235. The 237 had the short strike of the delta of -20, so 80% probability trade going in. And we brought in the spread was $46 per spread. Ended up, you can see here, just on that was a 24% return. So brought in a premium of 60 bucks credit, all right, from selling that bull put credit spread. Okay, then when it was going up, then we added the bear call credit spread to it to get a better entry by legging it. Or you can do it all at once if you're not sure, but sometimes the legging part is the great way to go if you get the legging right. Okay, so then it started moving up, and this was during the same day, and then it was up to trade at 253. So then sold the 267.5, 270, same spread width. The 267.5 short strike had a 23 delta, so that was going in just to show you the probability, 77% probability. and brought in $38 there. So it doesn't look like a lot of premium, but when you add the two together, that's where you get your potential better profit, right? So the two credits then together combined gave you a total premium of $98, which then your potential risk is the difference of 152. So remember, it's a $2.50 wide spread. Okay, the spread width between both of the spreads was 250. The total premium brought in was 98. I can't draw very well. So that's your potential risk. So you're risking 152 to make 98. So if it goes out between the two spreads here, that short put and the short call, you make 98. If it goes down below your long wing here or above your long wing there, you lose 152 on either side. All right. So that's what you would get. So your potential max profit, $98 premium on that risk of 152, 64% return on that type of trade. So that's very typical of what you'd be looking at for, an iron condor kind of credit spread. So here's, again, the risk profile. So you're short that call credit spread there, and then you're short the bull credit spread here, and it goes out between your two spreads. You make your 98 bucks, and if it goes below or above, you lose 252 or 152. Okay, so that's how that works. All right, so and then you can leg out. So if you're, want to leg out, you can do the same thing. You can close out the put side, or you close out the call side, or the preference is hopefully it just goes right out between the two spreads. So that's your iron condor credit spread. Now the next one is another one that we do quite a bit. We do a lot of butterflies as well. And the butterfly spread though can be a very low risk but high reward trade setup, and it's basically again combining these vertical spreads. So it's combining a vertical debit spread with a vertical credit spread. So in the prior example, it was combining two vertical spreads. So the max profit on that was just your premium received. But when you combine a vertical debit spread with a credit spread, then your potential profits are much bigger from the debit spread side of the trade. All right, so the butterfly then, what it basically is, it's going to have three striking prices involved, and it can be constructed either using calls or puts. So again, this trade is taking advantage of being short that time, short that volatility from the credit spread side component of the trade. Now this one though will give you a net debit, not a credit. So when you do a butterfly, you're going to be a debit type of trade. So in this brief example, here would be like, let's say you're long a call debit spread, okay? So you're long that call, short the call, but then you add a short call credit spread to it with the same short strike as your debit spread, okay? So that's the body of the butterfly. You can see you've got two short strikes there. That's what we call the body of the butterfly. And at that body is what we call, if it goes out at expiration at the body, that's called the top of the tent. That's your max profit. So in this example, this risk then was knocked down, was only $100. So if the trade did not work, and let's say the market went down, broke below that 1010 or broke above that 1030, your max risk is $100. You lose 100. But if it goes out anywhere in between here, you make a really nice profit. If it goes out at the top of the 10 at the very top at expiration, you would make, in this example, $900. See, the spread is $10, right? 1010, 1020, 1020, 1030. So each side is $1,000, $10 wide or 1,000, and your risk then is knocked down to $100. So your potential profit is 900 bucks or 900% return. So in certain situations, that's a great way to go. So that's another kind of way to take advantage of premium collection. Now the next two are the two that I'm gonna really cover in great detail next weekend. And these are, of all the different 5 alerts that I send out, you'll see from our results, the majority of the trades tend to be calendar and counter diagonals, because they're what I call a flexibility trade. There's just so much we can do with this kind of spread. All right, so let's just kind of go through. I'll walk you through how kind of the basic overview how they work. So the first one, what we're going to cover in the course is what we call the income calendar. This is kind of the foundation of the calendar diagonal, but it's kind of a really good medium to longer term non-directional or directional trade. Everything basically you do is to some extent directional, right? Even if the market goes sideways, you've got to get the direction right that you think, okay, it's going to go sideways. Well, directionally it's sideways, right? Or it goes up or down. So there's always direction to the market, even though sometimes we call these things non-directional. But basically what it is, the income calendar is kind of a neutral option strategy that profits when the underlying security remains stagnant or trades within a tight range. So the profit comes from the difference between the rate of your premium decay and the implied volatility decay or crush between the near-term option that you're short versus the long-term option that you're long. Now, this is possible because, once you understand option premium, remember when I was showing you earlier, the near-term options premiums go down, decay much faster, right? As you get closer to expiration, your theta decay accelerates. And so it really starts to decay faster versus if you're long further out, the premium decay is very, very slow. So that's how these work. These are called timing spreads, horizontal spreads, income spreads. So you're taking advantage of that near-term volatility, actually theta decay really starting to accelerate versus the long-term. All right, so that's what you're going to make money from. And the thing that I call this a flexibility trade because these can be super cheap, low risk to start out with. But then once the direction starts kicking in your favor, if you set it up right, then what we'll do is we'll adjust this to, typically the first adjustment will be to the calendar diagonal that we'll go through, and I'll show you next. And then we can adjust to a condor or a call debit spread or put debit spread or a butterfly. So we've got a lot of, it's kind of a process type trade. We've got so much we can do. So it's a great strategy then if you expect your security to stay stagnant in a tight range and produces that income from the theta decay. So used as a targeted range bound strategy, great for market conditions where you want to keep your long term position intact. So on a stock or whatever, and you're expecting it to eventually break out. So let's say you've got a position on where you think eventually it's going to kick out and break out to the upside, or it could be to the downside, but it could take some time for it to actually develop and kick out or break out. So this is a great way to collect that income or premium while you're waiting for that direction to kick in. So it allows you to be positioned to be getting paid while you're waiting for the the longer term breakout that you think is coming. Okay, so that's the beauty of it. Now your typical calendar or timing spread or horizontal would be, this would be like on a monthly example. So let's say what you're going to be doing is you're going to be long further out time, so you're going to have this slower time decay, right? So let's say we went out 60 days and we bought a $100 call. Okay, that was the strike, the $100 call strike right there. Okay, so that's going to decay at a much slower rate than we're going to, in a calendar, we're going to sell the 30 days in to expiration. We're going to sell a $100 strike of the 30-day option series. So let's just put, let's say this would be, you're going out to the November monthly and you're long that, and you're short against it here, the October, okay? So which one expires first? The October, right? So 30 days expiration will be the October. This is going to start accelerating. That theta is going to start really decaying a lot faster than if you're long 60 days out, say the November option. All right, so that's your typical calendar layup. And you can do this with calls or puts. So if you think it's going to go up, we would do calls, go down, puts, something like that. So here's just a good example so you can kind of get an idea of the math. So let's say you go out and you buy the November 38 call, and then you short it against it, the October 38 call. So that's that calendar look right there that you just looked at. Now, these are always done for a debit, okay? So that's your risk is your debit paid. So they're going to benefit from your time decay, and they're also going to benefit from that implied volatility crush, which at the end of expiration goes to zero. So you're selling short time and volatility right here on the 38, and you're long here as a spread. So these are spreads, so you're not naked short a call, okay? Now, these are going to be done for debit. Takes advantage of that accelerated time decay from the option that in the shorter duration time frame. And so an option contract, again, that's 7 weeks remaining will decay in value at a much faster rate than the long option, say that's 14 weeks out. So, you know, you've got that November, 38 call, that's roughly 14 weeks out, let's say, and you're short the October 38, 7 days or 7 weeks. So that's going to decay faster. So that's where you make your money. So if it doesn't go anywhere and you have this on, that's where you make your money. So it's a really cool spread in the certain situations of the market. And in the course, then that's what we're going to teach you. When would you put this on? And then how will we, adjust it to make it into maybe the diagonal or something else? So like I said, a flexibility trade. So here's that example. So you went out and you bought that 38 call, November call, you paid $400. At the same point in time, you sold against that, the October 38 call for $100 premium that you brought in. So you can see your debit cost then would be $300. Okay, so that's your rich, $300. Now the perfect environment, if the stock just goes sideways, that's where you make your money. So theoretically, it just has to go sideways, you make money. So towards the end of that October expiration, that 38 call you're short is going to be lower in value from the time decay than the long November 38th that you're long. So in this example, let's say that you get closer to that 38 option expiration, that call that you shorted for $100 now is only worth 50. We're just going to say the 38 November call is still about the same. So here you can see where your profit is. Now the spread went from when you originally set the spread up, it was at 350, and now it's at 400. Now it's at it's at 300. Now it blew to 350. All right, when you originally set it up, you did the spread at 300, right? And now that $100, that $38, $100 short strike now had the time decay hit it, and so it's cut in half. So there's your difference there, 400 less 50. So there's your profit of $50, which would be like about a 17% return, kind of like a credit spread. So these aren't going to make you huge money, but they're just the time value and the premiums the way you do it. But the way that I'll teach you in the course is that we'll start with this trade and then we'll turn it into something else. We'll turn it into either just a long call or long a debit spread or a butterfly or a condor or diagonal, and we can make big money. Okay, and I'll show you some examples on low risk. So, and this one last thing to show you, this is what we call positive theta and a positive horizontal skew. So one other thing is that we do have a positive skew, which you don't always have. That gives you an added advantage, and all that means is that the front series duration has a higher implied volatility than what's behind it. So just in this example here, this 28 February one day at expiration shows a 92 implied volatility on this series here, and you can see the week behind it's 87.58. So that's what we call a positive skew. And so, when you sell, if you do have a positive skew, then you're getting more premium from the short option that you sold in that series versus behind it, and that gives you that added additional, spread profit difference. Okay, so in the course I'll go through more detail how that works. So these are all the little bits and pieces that you need to know to understand the internals of it. So we'll go through all that in detail in the course next weekend. Okay, so your profit then potential max profit would be if it when the underlying closes at that strike that you're short, the short dated at expiration. That's your max profit. But typically we don't wait for that. Typically what we end up doing is adjusting it before that happens, and we're able to then adjust it into a lower cost discounted trade into a counter diagonal or a condor or something like that. So a lot of different things we can do. All right, so that's why the course will really open your eyes to these two really fantastic trades. So again, you can see that we do a lot of these with the alert service. So since starting these types of trades back in June of 2019 through yesterday, we've done 367 closed out, 261 winners, 27 break even, 79 losers, run about a 79 win rate, again on audited. So between all the five different alerts that I send out, we do the most will be these two types, and then the next types that send out mostly would be the condor and butterflies. But these are really two strategies that are, in my opinion, a must for any trader if you want to have a good trading portfolio, because you're not going to always have the same market. You've got to be flexible and adaptable to what you're being shown in the market. It's like the hand that you're dealt in a card game. You've got to be able to take advantage of what you have, what you're dealt. Now the next one is then the calendar diagonal. So this is what we kind of the next leg up. The first part is to understand the income calendar, and then we get into the diagonal, and all it is then by adding that spread, we get the big profit potential component. All right, so again, it's a medium to long term. We can go out and we can do this with leaps. These are sometimes you might hear it called a poor man's covered call. So this is another way to look at it. So we can go out 1 year, 2 years, whatever. We can use leaps. There's so many different ways we can do it. So it's a great way to speculate on trend, and it's a great way to be hedged. All right, so what it is, it's a vertical diagonal debit spread where you've got your long option leg expiration set further out in time versus the short option leg, which is going to be the closer to expiration. All right, so what's going to happen? The short leg is going to accelerate and theta decay versus the long, which is going to sit and not have as much decay. Plus, the other big advantage is that we're going to give this a vertical spread component, the diagonal. All right, so this takes advantage of the short-term weakness or strength. So we're going to get that short leg giving us time decay, right? So if we're the great advantage is that, like, if we're in a market where the market's come down real hard, and we're having it kind of bottoming out, but it takes some time. How it can take a long time sometimes and then move up. While it's bottoming out, we can get paid while we're waiting for that breakout to kick in, or the other way around. Even if the market's been up for a long time and you think it's going to visually roll over, but it could take time, we could do this with the put counter diagonal, and then eventually rolls over. We're getting paid while we're waiting. We just keep rolling and adjusting the short leg. So it's just a fantastic strategy. Again, you got to know how to do this. All right, so then if it's call based, boom, once it kicks in, you've got the diagonal. If it's put based, once it kicked in, you've got the diagonal. And just, again, it's kind of what I call the flexibility trade, because then we can really adjust. So that takes advantage of that accelerated time decay again from that front short dated option that decays faster than the back long dated. But the big part of this is you've got that additional vertical spread component. That's what makes it diagonal. Okay, so that additional vertical spread component, that's what adds that directional element for the greater profitability. And not only does this give us probability, but the other thing that we can do is, I'll show you the next example. We can take this spread here and adjust it to what, either a butterfly or a condor, which gives us even a bigger potential return on lower capital at risk than just the vertical diagonal. All right, so just can't express how important or how great this strategy is. Okay, and it's a net debit strategy. So I think the easiest way to explain this trade is that if you understand a vertical debit spread, either a call debit spread or put debit spread, all it is like a vertical debit spread, but it's not going to be in the same option series. So let's say, for example, we've got, next week we've got the 19 September series, right? Okay, so that would be the option series. So if we did, let's say we did a call debit spread, and we did, that would be, let's say, the 19 September, we'd be long that call, short the call in the 19 September series. So they're both in the same option series. Okay, so that would be a call debit spread. Now, which is good, but with the counter diagonal, the beauty of this is that we can go out further in time. And so if we really think something's going to take maybe a big trend up, we could actually go out and do this, with leaps. I mean, we could go out to the 27 December year 27, just for example of how far out you can go. If I can do this, okay? So we could actually be long this call out here in the December year 2027, just to show you the full extreme. And then we could be short against it next week. I'm sorry, I'm doing it the wrong way. I'm doing it backwards. We could be long here, the call way out in time, a December 27, year 27 leap, and then short here, let's say we're long here, the 90 strike. Golly, I can't draw this thing. And then we're short here next week, the 19 September 100 call, okay? So we've got we're long the 90 call, way out here, 2 years out basically, and short against it this next week, the 100 call. Now, we brought in premium here. Let's say we brought in $50, okay? So then next week, if this thing isn't $200, we keep the $50. That amortizes down our long dated that's way out there, that 90 strike. Let's say we paid $400 for that, and we kept the $50. Boom, we've amortized this thing down to now our cost is $350. And then we just keep doing that over and over and over. It's like some people call it the poor man's covered call. I call it the smart man's covered call, but that's the basic strategy. It's just a beautiful strategy to understand. Now here's a really good example. This one we just set up, and we're still in this trade actually. So let me just see if I can walk you through it. There's a lot of detail. Now this is what you're going to get if you sign up with the alert service, okay, that package 2, which would be 507. This is what you would get. So we use a app called Telegram. It's a free app that goes out, that sends these things out within seconds. So this is one that we set up. This was started out with Walmart doing this as a long call calendar diagonal. Okay, so we set this up on the 3rd of September. Walmart was traded at 98.50. I'll show you the chart and everything while we did it here in a few minutes. But here's just to step you through what we did. So Walmart on the 3rd was trading at 98.50. So looking at Walmart, thought it was going to eventually, it was starting to bottom out and thought it was going to break out, but it was going to maybe take some time. So went out to buy time, went out and did this as a calendar diagonal. So here it says buy one diagonal. So went out to the, started out to the 19 September right here series, which will be next week, but we started this on the 3rd of September right here. So went out and bought the 19 September 98 call and sold against it the 5 September. See that? 100. So there's your diagonal. So we're long the 19 September here, and we're short against it the closer in 5 September there. So that's going to accelerate, have accelerated theta decay. So went into this around $1.80, $180 where it was set up. All right, so that's where it started, and then I made a really quick adjustment because it's already starting to move up to that $100 call. So we closed that out, took some profit, and we adjusted this by selling, replacing that with the 12 September. We started with the 5 September, replaced that now with the 12 September 103 call. So we widened out the spread. All right, so now we had an adjusted trade, long still, that 19 September long duration time frame. And now we're into the 12 September, the next series, widened out the spread from 100 to 103. Okay, so that's these little steps we're going through, the process, and then the flexibility, whatever you want to call it. And then here is another adjustment. Now it was trade up to $198 profit on that spread. All right, so now the next here's where we made the big profit. by adjusting this into a long call condor. All right, so I won't spend a lot of time on this because your eyes will start getting cross-eyed if you try to read this. But on the 8th of September, we made this kind of final adjustments. It started to look like it was really going to break out. So what we did was, we're long that 19th September 98 call, and we were short the 12th September 103. This was at up around $190 per spread. So we took some profit, and then what we did was we bought to close. We closed out the 12th September 103 short call, and then we replaced that by selling going into the 19th September. We sold to close the 19th September 98 call for a big profit. And what we did, we replaced that with one strike up. We bought to open the 19th September 99 call, and then sold against that, look, the 19th September 103 call. So now we had a call debit spread, long the 99 call, short the 19th September 103. So now we had the call debit spread like that, but we did one more part of the adjustment. Later that day, when it went up more, we adjusted and added another leg to it. We sold a call credit spread against it and converted this to a call condor. So when it was moving up, we sold the 19 September 105, 110 call credit spread against it, brought in some premium. So now we adjusted this to a long call condor. All right, so this is what you're going to learn in the course, and these trades are really fantastic. So started out here with a calendar diagonal. So here's the trade setup. And this is what I want you to master in the course. So we had a really nice chart here. You can see Walmart, see this bottoming, came down to the 200. So it's starting to bottom out. Our indicators, cycle reversal, you're going to get this indicator with the course as a bonus. And then my momentum indicators right here, if you want to buy these, you can add this to the cart 195. So these were going positive. You see the green arrow there. So bought right here. So it's starting to break out above the 50 simple moving average, looking good, and then started to move up. We did this final adjustment into the condor here on the 9th, and actually on the 9th, and then we ended up, here's where we are yesterday. So let me show you what this trade ended up looking like, and we're still in it. So we still have more potential profit. So the original trade, after our first adjustment, we ended up with this. So we're long the 98 September 19 September 98 call. That's the original call, and then we adjusted it by selling against it the 12 September 103 call. So we have this call counter diagonal. Okay, see the two different series, and our adjusted price was $2.15 or 215 bucks. Now on the 8th, the day before we adjusted this on the 9th, I sent out an alert to take some profit if you had some to take. It was trading at 102.23 right here. So at that price point, now the spread had gone. It was at $413. The spread was at $413. We had our adjusted cost there at $215. So this was up $198 per spread. That's a 92% return. Okay, not bad. That's pretty good. Big positive theta here, but it gets better. That's why this is a flexibility trade. So the next day, we adjusted this into a long call condor. And what we did was we sold to close the 98 call that we were long. We had a big profit in it. So we sold that, took the profit, and then sold against that the 104 call. So we had this call debit spread, okay? And we had a really low adjusted price because we took big profit on the 98 call that we were originally long. That's the beauty of this. And then when it moved up later in the day, we sold against it to bring in more premium and positive theta, the 105, 110 call credit spread. Here's a bear call credit spread here, okay? Like I showed you, look at our risk now. We went from the original trade when we first started out, I think we had 180. We were at 215, right? Now we had our cost down to 60 bucks, okay? And now we've got the spread. We've got a $5 wide spread now on both sides. So we've got the 500 spread width, less our cost of 60 bucks, max risk, potential profit next week if it goes out in here between the spreads, 440 bucks. that'd be a 733% return. So we started out the trade with, potential to make maybe 30, 40% return. Now we have the potential to make over 700. And here's where it was yesterday going out. I sent an alert out to, if you did, want to take a little bit more profit. Here's where it was yesterday. It was trading at 103.45. Okay. So that spread went from, we've had an adjusted price here. Now it's blown out to 340 bucks. So we're up $280 a spread. We're up currently 466% return on this trade, which originally started as a call counter diagonal. So that is the beauty of this trade. Now let me show you, I'll just kind of go through more detail here. So here it is. We did another one the other day. We just do a lot of these. Here's one we just set up. This was on XLU, the utility ETF. We set this up on the 10th, and we have this as a counter diagonal, but here's the Walmart trade. Okay, so the Walmart trade, we got in here on the 3rd, right here, so you can kind of see the progression of the trade, really important. Okay, so Walmart, okay, started to see the momentum, see the reversal, and so we bought it right there. Okay, the original trade was that counter diagonal. The next day we did one adjustment to make, here we started out with the 98.100, and then the next day we adjusted this to the 98.103, and then on this day, this day here we converted it to the call condor. All right, so now, our short strike of the credit spread is up here at 105. So let me bring up the profit, let me bring up the option chain here. So now we've got this trade on currently, adjusted this to this call condor, and you can see where it went out 280 now. Next week, if we go out between our spreads of 104, 105 up in this range here, this will be up over 400 bucks, over 700% return. And then our maximum risk, if it was to crater and close down below 99, we'd lose 60, or if it closed above this strike up here at 110, we lose 60, but this is all profit in here. So just a beautiful trade. Look at the theta. It's got a huge positive theta. I add in that credit spread. Look at that. We're almost making $10 a day. If it just sits here, we're making $10 a day. So here's the beauty. If it just sits here, right here, I'm going to change the calendar. So if it just sits here until next week, the 18th on Thursday, look, it doesn't move. We're up 337. See the theta? Look at that. Now the theta's increased to almost $24. See that? So this is a must-know strategy if you're serious about options. So it's exciting. It's an exciting trade, and we do a lot of these. So that's what I wanted to make sure everybody got an idea of what you're potentially there to take advantage of if you join me next weekend. All right, so that's kind of where we're going to end up now. Let's go to the next step here. So today, I just wanted to get everybody a little bit better educated on the types of possible income strategies out there to generate income. Also by taking your risk lower, to give you a general feel for it, and show you some different types of strategies that you could use. But then if you'd really like to, really learn some strategies too that are just so dynamic and are a must for any trading account, then I highly recommend that you join me next weekend for this, okay? So this will start next weekend on the 20th. And this will be just going into two of these strategies, the income calendar and then the calendar diagonal. All right, so again, use this special link here. Sorry, let me get you that link. It's Power Cycle Trading. You can see it down below here, powercycletrading.com/special. Just copy and put that in, or let me get it up for you. And then put in that lower cap, Cal 15, and hold on. All right, here you go. All right, put that in, and then small cap Cal 15, and then pick the package you want. I'd highly recommend, obviously, the alert service, because then I do all the work for you and pick out the good trades. And then it takes a little, and you know, run about an 80% win rate. So you know that I spend a lot of time looking for good setups, and these setups that I typically will send out, they're pretty good. They typically don't go against us, because the entries I'm really fanatic about getting precision entries. So I would highly recommend package 2 if you can. All right. So this will start the next weekend, then we'll finish Monday at 4 p.m. Eastern, and then we'll have a Q&A dedicated for it the next day. So you're going to get this with all the different the bonuses here, the indicators, everything. This is what you're going to need for the course as well. So going through all the details again, and any questions, let me know. Hey there, Salvasar. Okay, so today, you know, course value $1,600. When I go out this next week to my client, my list, 197 today for everybody here, 167. And this will include my cycle reversal indicator, and this is available for Thinkorswim, TradeStation, NinjaTrader, eSignal, TradingView. And also then you're gonna get my extreme range band. These are 2 indicators that we will use in the course. And then you're going to get my price target mapping course. This is Fibonacci plus some other things that I put in there for target mapping. So I'll show you a little bit more of that. That's $297 my site. Then you're going to get a 30-day trial membership to my trading club. And then you can start this, you know, after the course if you want, so you don't have to start right away. And then if you want to stay on, it's $97 a month, or like I said, we do have different packages that you get. Then we'll do the follow-up Q&A for that, and then you're going to get my option trading tutorial, which is another nice little option guide course for you. So a lot of really nice bonuses here today. So full course value over $2,700 for everybody here today. $167 for that course package 1. Now, if you want the alerts added to it, you're going to get everything in course package 1. But then on top of that, you'll get course package 2, comes with my 5 different alerts. So, you know, depends on what the market's showing me as to what I'm going to send out. But we do, like you see, the most trades we typically will send out will be calendar diagonals. That'll be number 1. Should have linked these in order. So that these are number 1. And then we do a lot of condors, butterflies, and then we do very selective, what I call pinning trades. You're going to see a few of those. Breakout reversals, these are credit spreads typically. And during earnings season, very selective earnings trades. All right, so that's, you know, what you would get there, and that's for 4 months. And also that comes with my trading club for 4 months, which gives you access to my virtual trading room and a bunch of other things that I'll show you just in a minute. Hey, thank you so much. Wow, let me share this. Thank you so much, Shamesh. Thank you so much. All right, so that's everything you'll get there, and then you can start and stop this when you need, if you do go on vacation or whatever. All right, so that pretty much summarizes it, hopefully. Now, if you do want to break it down even further, I mean, I broke it down for you. If you're looking at this package day 507, you know, you're basically paying $4.20 a day to get something that's an investment in yourself. Or if you just look at it here, the alerts broken down, you're just that part of the service is just a little over $3 a day. All right, so we're, you know, these are the types of trades that I send out will be butterflies or condors, calendar diagonals, specific pinning trades, credit spreads, earnings trades, things like that. All right. Now, when I do send it out, I send out very detailed trading guide, which you saw in that Walmart. I'll show you some other examples here too. Then after the end of the day, I'll do a setup video review of it to show you, why I was doing the trade, what I think is going to happen, why it was done. Trades are listed in archive. Do a weekly Q&A. You'll have access to that now for the next 4 months. Do a market video newsletter every day after the close. You'll have that for the next 4 months. access the virtual trading room for the next 4 months, and that should be 50% on all courses and software on my website. All right, so you get a nice discount there as well as a member. So, went through the alerts here. So the combination of all 5 of the services that I started out, back in May of 2018. So it's been a while, but we've been running very consistent win rate of around 79, 80%. That's what I'm shooting for, to give you high winning percentage type trades. All right, so really 928 closed out, 666 winners, break even, losers, unaudited trades, right there, summary of those. So that's what you're going to get with course package 2. And again, make sure that you use that powersuppletrade.com/special right here. Oh, wait a minute. And then Cal 15 to make sure that you get the discount. And there's also the 2-pay if you want 2 payment. You can do that. Plus, add the indicators if you want to. Highly recommend my indicators. It's what I use for every trade. And then Cal 15. Yeah, there you go, John. Okay, so that's just a rundown there. Now here's just a little bit, from Pam. This one of my longtime members said, just sending a quick note. No, you can get the indicators added to either course package 1 or 2. Let me show you. Somebody wants to look at the indicators. Let me just show you how that works. I'll pull up the link here. Hold on, that's a good question. All right, let me show you. All right, so here's course package. So if you go here, either course package, you can get the indicators if you want to add those. Okay, here's course package 1. All right, so when you go in and click the buy link, these are available for Thinkorswim, TradeStation, TradingView. I do have wealth charts, but not in this package. And they're also okay, for NinjaTrader. So you can come down here. This is course package 1. All right, 197. And if you want to add the indicators, just add to cart right there. Put in your Cal 15, you'll get the discount. So that's course package 1. All right, so you get that. So you're going to get everything there plus the indicators. And then if you do course package 2, it's there as well. Okay, come down here. And if you want to add the indicators, just add to cart, add to order, and you can also do the 2-pay if you want. And then you'll get the momentum indicators, and it also has is a 5 steady set indicator package with volatility squeeze, momentum, etc. These courses are all updated. Question, every time I do these courses once to twice a year, so they're always updated, okay? So the markets change, examples change, different, strategies change. The basic concepts don't change, right? I mean, the basic foundation of a calendar diagonal are all the same. They're spreads. They don't change. The basic foundation of a butterfly, they're all the same, but the markets change. So yeah, they're always changed, always updated, always. So here was from Pam. She said, quick note of thanks to pass along to Larry for all the fabulous teaching through the years. I truly enjoyed learning from him, the other traders in the trading room every day. I don't think there's a better trader in the world when it comes to option spreads and other ways to trade than Larry Gaines. So I really appreciate that. Now the course, then we're going to start out on Saturday. We're going to start out with the first part, kind of the Greeks that you need to understand. I always like to go through those to have you understand how option pricing works for the various spreads that we're trading or going to learn to trade. So we'll go through the Greeks. how that time value works, trading the probabilities, things like that, so standard deviation, these are also important. And then part two, we're going to start out with the foundation of this, the vertical income calendar spread, the basics of that spread in more detail, the benefits of the spread, the characteristics, what make it work, how you get that trading edge, what I call time and theta edge, risk review, the trade setup review, and then what we're going to do is kind of what I call a progression of the trade. So we'll start out here, and then what we typically do on any of these trades, we may start out with a calendar, which is super cheap, low risk, but then the next progression is we're looking to change that into the calendar diagonal, adding that vertical spread component. Okay, so that's the next progression, and then we go to that part two or three. We dive into the calendar, and this is just, again, probably it's hard to say my overall favorite because we do so many of these. Okay. We'll make sure that yeah, well, that's a great reason to come to the course there, Arthur. Make sure you join us. So part two, we're going to go into that progression into the calendar diagonal, the basis of that, how it works, the benefits. But then what this offers is what I kind of call two trading edges, which are going to be the time decay component, which is a major edge. But the next big edge is that directional component from the vertical diagonal spread component. Trade setups, and then we're going to go through these adjustments. How do you make those adjustments into, we go from a calendar diagonal into, maybe we could adjust it to a butterfly. We could adjust it to a condor. We could adjust it to a vertical spread. Just the flexibility here, the progressions. It's just a great trade setup. And then the resources, you'll get a lot of different resources I use in a trading library, so you can go back and look at trades, past trades, to show you how they work. So a lot of times, one of the best ways to learn is look back at your winning trades or even your losing trades to see what worked, what didn't work, and that gives you a really good way to educate yourself. All right, so here's what you're going to get on the enrollment bonuses for next week. You're going to get these, will be used in the course. You'll get my cycle reversal indicator, and this is available, and you can have it on any of these platforms, Thinkorswim, TradeStation, TradingView. I've also have these available for Ninja Trading, Ninja Trader. Okay, so this is my cycle reversal indicator. It's got an upper and lower study to it. So the lower study is actually the indicator, and then the upper study will give you the arrows when the reversals happen. So you can see here's that reversal there, etc. So that will be part of the course bonus package because we'll be using this in the course, for setting up these types of trades. All right, so you can see kind of here's a little bit better picture of it up here. Here was a nice cycle reversal right there. See it reversing here, the arrows pop up. Here's cycle reversal down here. Anyway, so you'll get this indicator as a bonus part of the package for either package 1 or 2. Both come with that. And then you'll get my extreme range band indicator. So this shows you when markets get too stretched to the upside or downside. It's a really good indicator for finding maybe potential tops and bottoms to the trade to trade against. And we have this for Thinkorswim, TradeStation, eSignal, Ninja Trader. Okay, so these are my extreme range bands showing you when markets get overly stretched up or down. Then combined with my reversal indicator that you're going to also get, give you a really good setup for selling options here maybe, or buying options down here, these different spreads, right? So you'll get this indicator as well. Yeah, the indicators are on TradingView. Yeah. All right, and then you're going to get bonus 3 is my price target mapping course. So it's based off of Fibonacci, but it also combines kind of 4 or 5 different things I combined with Fibonacci. It also looks at moving averages. It looks at support, what I call price action support resistance. and standard deviation analysis, and unusual option activity. So it's a combination of 5 different things that I use in this to give us price targets. So we use this to set our profit targets up or defense targets down, up or down, to set targets, okay? So this is a really important course. So you get this 3+ hour course on that. That's, you know, a bonus with both packages. Everybody would get that. And then you're going to get my Power Cycle Trading Club access. So here's where you get, if you do package 2, you'll get this for the next 4 months. And you can stop and start when you want. If you do package 1, you'll get this for the next 30 days. And you start this, you know, after the course if you want. Now, I've changed the trading room hours. Now we're open. The trading room is every Wednesday through Friday, 9:30 Eastern to 10:30 Eastern, okay? And then on Tuesday, though, we do, every Tuesday, I do a live Q&A, okay? So we're covered every day of the week. So used to have the trading room open Monday, but Mondays, what we would typically have is kind of a no trade day on Monday because the markets are just trying to figure out what they're doing from the past week. And then there's the old thing, turnaround Tuesday, right? So Monday might be up and then Tuesday's down. So just went ahead and just put Monday kind of aside, and then we start up with Tuesday with the live recorded Q&A. That'll be at 11 a.m. Eastern, and then we'll, you know, have that Tuesday, and then Wednesday through Friday we do the trading room. All right, so then you get 50% discounts on anything on my website, any courses, or any of my indicator package software. So you can see here, if you want anything on the website, once you're a member, you can come in here and buy any of my courses. They're all updated. You know, I'll do these either once or twice a year. So you'll see all the different courses that you can choose from, and then, you know, pick. But again, if you do today, you're going to get a much greater value with all the bonuses and everything you get. But then you can go back and with your discount get anything you know, in here. And then if you want any of my software, you can get any of that on the website. My volatility scanner, my custom indicators. This gives you all the study sets. You could add that to the cart today for $195. Great deal. My multi-squeeze indicator. Here's my extreme range band. My, you know, just a lot of stuff that I've developed here. Here's a cycle reversal indicator that you're going to get as a course bonus. Here's my extreme range band indicator. Okay, so you'll, you know, get any of that as a member's discount of 50% off. And this is one thing I always like to point out from Jay, who's been a long-time member now. He said, reading books is fine, but seeing the actual option trade setup makes a huge difference. And that's the trading room where that can really come in handy for anybody that wants to learn. You know, like I've been doing this for a long time, so I've pretty much seen it all. Not that I know it all, but I've seen pretty much everything. And then we'll do a follow-up Q&A on Tuesday after the course, dedicated to the course. And then you'll, you know, also come in the virtual trading room. So that's bonus 5. And then bonus 6, you're going to get my option trading tutorial, just another option course. This is a 60-page option course with videos on the Greeks, delta, gamma, theta, you know, how option pricing works, standard deviation, trade probability. So just more option education for your library if you want to add it to it. And then here are just a few more examples of recent alert trade setups. Now this is, you know, from one of my members, Waleed, really nice comment here. He said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not great. But one thing I would like people on the webinar to know is that when I get a trade alert from Larry, I do it blindly. It's time to show me this man is dead accurate in his recommendations, Waleed. And then Dan said, you're very diligent and totally thorough with your analysis. That is the foundation of your success to the alerts. Paid for my subscription here with the first 4 trades I took when I was just learning how to trade options, okay? So please feel free to share. So a lot of members have done that. And then a lot of alert members just want the trades. They do their own thing, okay? Now, when I send out alert, it'll be either a butterfly or a condor, counter diagonals, penny trades, which are typically butterflies, or it could be a selective credit spread, or, you know, selective earnings trade. So I'll always give you a guide the option guide for it. So here's the, here, for example, we use this service called Telegram, which is right here. And I'll show you another trade. So it's just very detailed. These are all the alert updates that I sent on Friday. Okay, here's the 12th. Look at this. Here was a new trade that we set up, the short trade. This was on CRM. I'll show you this in a second. New short CRM trading around, et cetera, et cetera. So I said to do this trade, set this one out, do in a put calendar, a put condor. All right, so that was a put condor. Here's a trade that we set up the day before or 2 days before. This was on a counter diagonal on XLU. That was sent out. That was an update alert on Friday. Here was a Walmart update alert. Here's Walmart long. Here's some CRM, an update. Okay, so constantly sending out updates for you to keep you abreast of what's going on, so you don't have to be watching. So you get that setup video, and then I'll do a video review of the trades each day after the close. And so you'll have access to all this for the next 4 months, the trading club for 4 months, virtual trading room, all that for 4 months, plus discounts of 50% off. Suggested option trade, but like I said, a lot of members just want the trades. They do their own thing. They just want my trade ideas. But when I do send it out, I'll always send it out with your entry level and the option trade to do that I would suggest or recommend doing. I'll give the profit targets in the trade. Usually I'll give you 2 to 3 targets that we're looking to hit based on Fibonacci price target mapping. I give you what option series to use, stop loss levels, and then constantly updating the trade from inception until we end the trade to tell you to take some profit, do adjustments, et cetera, So a lot of constant updating, and then do a video newsletter, video review each day after the close of the market, what we're doing on the trades, and then we do that trading virtual trading room every day now from Wednesday through Friday, and we did the Q&A on Tuesdays here at 11 a.m. Eastern. All right, so that's everything there. Here's just a couple of more calendar trades. We do a lot of these. I showed you the Walmart trade. Here's another one we did recently. This was on DraftKings. These are just parts of the alerts that are sent out, just kind of chronologically set up, the steps of the trade. But this was a really great DraftKings trade that we did as a call calendar diagonal and adjusted this to a broken wing long call condor. And so this was one that we set up. Here was DraftKings. The setup was starting to make its move here, right here. Cycle reversal, my indicators. We're in what we call a volatility squeeze. Did an adjustment here, an adjustment here, profit here. So this was adjusted into a broken wing long condor. Okay, so we originally got into the trade. It was trading at 45.58. And when we got out of the trade, it was trading at 48. So these are just, what you'd expect to potentially come out. And then here was the original trade. We had this set up as that call calendar diagonal on DraftKings. And we had a little profit take here on the 22nd. So the spread we got into at 92 and blown out to 153. So now it's up about $61 a spread, 66% return. But it got better because we adjusted, and this is what you're going to learn in the course, is how to take these to the next level to an adjustment. We're just not going to sit with these all the way through with the calendar diagonal or whatever it is. So then we ended up with this as a broken wing call condor. So long the 46.48 call debit spread, and then sold against it the 49.552 credit spread. So it's a broken wing, looks like that. Total risk on this trade, we had a $36 debit. We adjusted it down a debit cost of 36 bucks, potential to make $164 in there. And I think we made max profit on this trade. All right, so this was a pretty cool trade. And then, made pretty close to max profit on this. Here's where it went out right there. So it went from 36 bucks to 193. So $157 per spread, 436% return on that. This is started out as a counter diagonal. Here's another one, KRE. This was the regional bank. This one started out as a call call calendar, all right? This is what's so cool about this. Look at this. Look at this trade. This started out with our total risk of 58 bucks right there. I think it was 55, but that was set out for 58. And then we ended up adjusting this into a call condor again. And we were up, look, over 1,000% return. So this is the game plan, right? So then adjusted this. And so here, look back here. This is what's incredible. This started out as a calendar, total risk, 58 bucks. I didn't show you everything because it just takes too much time, but then we ended up adjusting this to a call condor, and look where this thing ended up going out. We were up over 1,000% return. So we adjusted this down to an $8 debit cost, and it blew to $161 a spread. So this was up $153 per spread on that cost, 8 bucks, 1,900% return. So these are possible, but you just need to know how to do it, and that's what you're going to learn next week then. All my indicators are available on Wealth Charts, but I have no control over the price. They're all, it's a partnership, but you can buy my indicators, for Wealth Charts. So I've just got I've got a partnership deal with Rob and Wealth Charts, and they have all my indicators on a great indicator, great platform. So, get them on Wealth Charts. They're definitely there. So that's that. And then here, just a couple of examples of the butterflies. These are the second most that we do. So started this back in May 2019 through yesterday. We've had 236 trades closed out, 170 winners, 19 break even, 47 losers. Running an 80% win rate on these. These are real low risk trades, $75 risk, et cetera, but you make up to 25 to 1 on these. I mean, these are just sometimes incredible. But we do mostly the calendars and counter diagonals because, like I said, we call those the flexibility trades, and then we adjust those into these. So, but here's a straight call condor trade that we did on Amazon. And this was back in July. So, we're doing counter diagonals or condors or butterflies. Here's one that we did on Amazon. So we did this trade here. Amazon was trading right here. And, I'll just kind of skip through to show you the gravy, unless you want to, see more details. So we set this up as a pure condor. So we went long the 227 at 230 and short the 235, 237.5. So we had this condor set up. We adjusted this up a little bit, so we had increased our debit cost, but we had this on at $105 debit, potential to make 145, and I think we went out right about in that range. Yeah, we went out right there, so we made max profit on this, $143 per spread, 136% return. Here's one that we did on Palantir, PLTR. I'm just showing you where it went out. This was up max profit. This was a condor, so we set this up at 72 bucks, went out, spread blew to 200, made $128, 177% return. Yeah, everything's recorded, Arthur. Yeah, everything will be recorded in the course, broken down in modules of 30 minutes or less, like a chapter of the book. So everything will be recorded. It'll be yours forever. The course will be yours forever. Even if you don't stay on as a member, you'll always have access to your anything you buy on our at Power Cycle Trading. Now these are really fun. These are very selective though. Here's what I call the lotto ticket. This is the butterfly. Sometimes we'll see something like this, and I'll send it out as an alert. This is one that we did on the SPY, a butterfly, and so thought I had the alert package. Anyway, so we did this as a butterfly for a pin. And it was traded at 573, and this was an alert trade. I thought I had the Telegram stuff on it, but I left it off for some reason. And anyway, we set it up on it was traded at 573. We're targeting down at 560, so did this as a butterfly on a pin trade, and I'll show you this one pinned perfectly. So occasionally you're going to get something like this. So we did this 565, 560, 560, 555. Put butterfly, spread width $500, total at risk 39 bucks, $39, and max potential profit. If it goes out top of the tip, 461, 1100% return. This one nailed it pretty much to the penny. Went out right there at 560.32, right there. Pretty much nailed it. So it's up $417 a spread, up over 1,000% return. And then I wanted to throw in an earnings trade to show you that you're going to also have this when we have earnings season. This is one that we did recently, was an earnings trade. So this has been really high winning probability. Started this in June of 2019 through, that should be yesterday, but we've had 145 trades closed out. These are very, very selective. 106 winners, 17 break even, 22 losers. Running any 85% win rate on these. Again, very selective. I don't do tons of these. These are super selective. Here's the last one we did. We did this on a firm. So this was very detailed. You can see I sent this out. Even if you don't know how to do this trade, you can read this alert and you can figure it out. You can do the trade. All right, so this is the trade sent out on the 28th, and the next day was her profit. And so this is what we call the Iron Condor debit spread. So this one was for a big price spike. We set it up right there and it blew out, did exactly what we were hoping it would do. We set this up for big either spike up or down. And so this was an earnings trade. And so this one worked out perfect. And we made 50 bucks a spread. These are very selective. This was a $50 spread, 33% return in one day. So that's kind of an overview of everything, but the main meat and potatoes next weekend. So I really hope you guys and gals will take advantage of this offer and join me, and you're going to learn a heck of a lot. And again, think about long term. If you are looking for some longer term way to trade the markets where you can use leaps, this is the perfect strategy for you if you want to join me to learn it. So if there are any last questions, please do let me know. You want to, the CRM, I'll check that out. We did a short trade. It's hard to short this market, but did a short trade on Friday, shorted CRM, and we'll see where it goes. I mean, we see if it breaks this level here, it's got a pretty quick path down here to 234. So we set this up a super low risk trade doing what we call, this is a put condor. Okay, so these are trades that I sent out. This was an alert trade. So sent this out. We did this on Friday. And so this is a put condor alert trade that was sent out. So basically looking for this downside move here, and look at our risk. We've got a total risk of 65 bucks. And the other thing we can do with this trade, we can leg out of this trade if we want. So there's a lot we can do. So it went out of, $29, almost $30 a spread. Has potential next week to make potential in this trade is $185. If it goes out between the spreads here, that's $185 on that risk of 65. So it's got a really, nice positive return on that trade. So we potentially can make, 280% return. So this is a combination of a debit spread with a credit spread. All right, everybody. I appreciate everybody's time here today. I hope you got a lot out of the course, this workshop, and I hope that you'll join me next week. And yeah, here, John, here's that link one more time. And make sure to use it today to get that discount, and then use CAL15. There you go. And again, everything will be recorded next week and broken down in modules, 30 minutes or less. You'll get the full course PowerPoint, all the recordings and handouts. So you'll get everything together.